Welcome, I'm your host, Nate Barger. Thank you for tuning in. Make sure that you subscribe, hit the like button. Today we got some great information for you. It is June the 3rd of 2021. Happy birthday to my son, Alex, and all you other wonderful people out there who are celebrating a birthday. We want to talk about, is it a good time to BRRRR? Everybody seems to have an opinion, but I want to dig into the facts. I don't want you guys to have an opinion that's not backed up by facts. So we're going to jump in. We're going to try to imagine the worst housing crisis that we experienced in my lifetime was in 2008, 2009, 2010. We're going to look at what happened and what if something like that was to happen again and you just bought your first BRRRR. Are you going to be okay? Or are you going to get crushed? Are there any indicators that we were going to have a housing crisis and an oversupply based off the numbers that we look in? Mention below if you think yes or no. Go ahead and comment below if you think yes or no. And again, make sure you hit the like button, please. Thank you. And subscribe. We're going to give you all the data you need to make good financial decisions based off of the facts that we're looking at. We are not a financial advisor, not a CPA, not an attorney. Matter of fact, I barely graduated high school. But I do know how to do real estate. So let's jump right into this here. As you can see, based off the charts, in 2005, the U.S. average rent was $944, then $974, then $970, $1,028. Wait a minute, what happened? It pulled back a little bit. We got some turbulence. $1,010, $1,008. $994, okay, $997. Okay, we're making a rebound by 2012. By 2013, we're back up. By 2014, we broke through that number. So we're talking about a 6-year gap between a height, a pullback, and breaking back through. We're not talking about a ton of money. We're talking $30, $40 a month. But did you really lose $30 or $40 a month? Well, this is the departmentofnumbers.com. And let me know what area you're in because we'll pick one out. We'll do a video on an area next week as we update. We'll dig into this and let you know what your area looks like going forward. So let us know what city you're in. Pick one of the subscribers and we'll do your city. Okay, guys, so we're going to jump over here to Fred. This has some really good charts on it. Fred stands for, what the heck does this stand for? Federal something, I don't even know.
I'll put it on the screen.
There you go. So, but guys, let's look in and jump in and see, because we had $1,028 in rent. That was your average rent. But if you know, if you're a landlord, if you don't know, that's not how much you actually collect. You're going to have a vacancy. So let's see, according to Fred, what the vacancy was in 2008. Wow, it was 10%. So times 0.9. That means that you were collecting $925.20 a month. Look at this, guys. I think we found something. So why would you have this much vacancy? Well, yeah, job loss, number one. But number two, you see it all the way going back to 2000. This is way above average. So when everybody says, are we going to have a housing crisis? Well, let's look. One of the most important things you can look at is how much oversupply do we have? How do we know what is oversupply? When you start having high vacancy, and look at this, starting in almost the late 80s, you know, through the mid 90s, 91, you went to 7. Then at 2000, it seems like we had a lot of people you didn't have a lot of new people. You had baby boomers, and then you had Gen X, which is me. We didn't really start needing housing till some of you guys are still living in your mom's basement. But we really didn't start needing housing until, you know, right around the late 90s, because I was born in 75, you know, mid 90s. So, and then and then you had the millennials come in 2010, and look what happened, guys. We have all this demand in housing, and it's continuing to shrink. Look at the vacancy rate, guys. So we know we collected $925.20 in 2008 if you merge these two together. Now, let's jump back over here to go back to 2011, which was $994. Okay, so in 2011 we collected 994, but let's see what kind of vacancy. So 2011 we were at a 9 point. We were at about 9.2. 9.2 is merged together. Let's say a probably a 9.5 average. So we were at 994 times 90.5. So our effective rent collectible was $899.57. So it did go down a little bit. It went down 25 bucks. But what I need you to understand is this. Housing prices continue to climb through that. So let's go and let's look at the next chart. All right, guys, so look at this here. The housing price coincides almost directly. You have a peak with occupancy, and then it looks like you have a sharp downturn. So let's say you would have bought at the worst possible time, peak $322,100 average in the end of Q1 2007. That means that you would have been projecting a 970 rent. A 970 rent. Let's go to the vacancy. You would have been projecting a 9.8% vacancy, which means that you would have had 970 times 0.902, which means you would have been projecting a $874.94 as your rent. And then all of a sudden, prices started sliding, because I know this is what you guys are always worried about. Prices started sliding and you went all the way down to 263. You felt like you were losing your shirt. But we're not worried about prices because we're not sellers when we do the BRRRR. We buy and we hold. We're looking for long-term wealth. This is how you accumulate wealth. You don't accumulate wealth by buying something, worrying about it, and then trying to sell it quick. It's a long-term play, but you can get wealthy relatively quick. Let's say you would have bought in 17 or 07, and let's say you would have bought 10 of them. Well, today you probably would owe close to, let's see, you would have paid $322. With your payoff 13 years later, you would owe about $240, $250. And today that property would be worth $403. So you'd have 150 times 10 houses. You have 1.5 million. You'd probably have a lot of cash flow. Let's jump back into this and look at the cash flow part. So your effective rent in 2011 would have actually been higher than your projection in 2007, even though your price dipped. So the thing that I really want you to grasp from this is, even when we do go through a recession, even when we do go through an area where prices do pull back, rents typically do not pull back. So I think it's pretty safe to say that you just need to get out here. I think you need to understand your local market, because your local market can dictate and change a lot of that. But what I really need you to do is just dig into the facts. Don't be reactive, be proactive. And right now, if we're still hanging on to that same property, let's see what kind of effective rent. You would be at $1,164. And this is 2019 numbers, pre-COVID. They probably jumped $100 since then. Prices have gotten quite crazy since then. So let's go back and look and see where you would be at today. You would be at $1,164 in 2019. And let's go see what the vacancy rate is. So vacancy rate for 2019 was right around 6.8%. So we're going to take 1164 times 0.932. So your effective rent is $1,084.84 versus $874.94. $209 pickup. So let's say you were BRRRRing back then. You had $200 in passive. And now you got $400 a month in passive. You got 10 units. It's $4,000 a month. So guys, the moral of the story is, don't be afraid to buy in any market. understand what your market looks like, what the job drivers look like, your vacancy and your average rent, what that looks like, guys. So based off this right here, I want you to comment below. Do you think it's a good time to buy right now, or do you think it's a bad time to buy? Look forward to your answers, and make sure you subscribe to us and hit the like button. We appreciate you. We'll talk to you soon. Make sure you hit the like button, subscribe to our channel, Nate Barger on YouTube, and hit the bell, and you'll be notified on any new videos that come out.